Welcome to Channel 17, the Town of Colonie Government Channel.
Hello and welcome to The Money Factor. I'm Richard Naylor, your host. In today's program, we'll be discussing retirement budgeting and managing retirement money. Our guest is John Shartrand. He's Chief Investment Officer of Capcom Financial Services, and they are a part of Capcom Federal Credit Union. I'm really happy to have you back.
Yeah, it's nice to be back. Our conversation was so good last time, I couldn't wait to come back. So.
And the neat thing about it was I had my own questions. I'm cutting the grass and I'm thinking, I've got this nest egg. How do I want to end up broke? But how would I do that without, maybe I'm 5 years too short, or,
Yeah.
I wouldn't want that to happen. And in preparing for the show, I looked a little bit at some of the actuarial tables. And I was kind of misinformed before,
Sure.
where maybe a male, a male's average lifespan is 76 and a female 81, and that's where I stopped. But then the actuarial table told me, yes, but if you're 65, you can forget about all the accidents, the war deaths, all those things. You're probably going to live, another 17 years, and if you're a female, 20. So now we're into the 80s for an average person. So I could live to be 90, 92 if I'm really lucky.
And of course, we're all above average, so we're all going to live longer than that.
Like Wobegon, right?
Yeah, that's right. Well, those are individual statistics, and at Capcom we do a lot of retirement planning. Our profession is helping people transition from work to retirement, and what happens is, especially if it's a couple, when you take those statistics, if both couples make it to age 65, there's a 50% chance that one of them will make it to age 92. And there's a 25% chance that someone will make it to age 97.
Wow, this gets much more difficult.
Well, so think about that for a second. If we step back and say, well, that's up to 27 years, 32 years in retirement. And we're in 2011 now. So what were expenses like back in the late 70s, early 80s for people that retired back then? Are they the same? And the reality is no. And that's some of the stuff, and it's a great topic you picked to talk about budgeting and retirement income today, because it has an impact.
So let's get right into it.
Sure.
What do we do? I mean, how do you budget? How do you prepare for retirement?
Yeah, budget is such, no one likes to hear that. Who wants to be on a budget? Who actually wants to watch what they spend? That's just crazy.
It's kind of like dieting?
Yeah, it's like dieting. No one ever diets. I'm just watching what I eat, yeah. Budgeting is, I just try to break it down. We try to break it down into need and want. It's, what do you need every month to cover those expenses, the housing, the food, the gas, your basic expenses. And what are some of the things that you want? This summer I'm going to go to Cape Cod, so I set aside money each month so that when the summer comes, it's not something I have to do, but I want to do it. And if I have enough money and I'm, kind of maximizing my 401k at work, then I feel it's appropriate that I could take a vacation. But the reality is if I'm not saving enough for retirement, I might have to sacrifice and maybe not go on a vacation to make sure I'm saving enough for retirement, to prepare for that retirement budget, which is what do I actually need and what do I want in retirement.
And of course, the want can be even more important than just a mild want, because it could give you a sense, I would think, of happiness, even throughout the year, looking forward to going to Cape Cod, whereas otherwise you might think, I can't afford to go to Cape Cod. And now 12 months, you're not looking forward to a vacation, you're thinking, what did I do wrong?
Yeah, retirement is actually, it's interesting from that standpoint. I think what people do have to remember that it's a journey, not a destination. So those things that you want to do in retirement might be one thing as you transition, but it might change. We were just talking about potentially living 27, 30 years within retirement. When you first retired, there might have been some things that you wanted to do. Well, 10 years from now, I mean, even now I'm working, but what I used to do 20 years ago is not the same things that I want to do today. And that will change. And the budgeting or what that you want to do, that's the kind of expense side of the equation, and it's all going to be dependent on the revenue side of the equation. How much income or revenue can you generate to meet those needs. So
I think it might be worthwhile just to go through kind of broad brush. There are books, and people could come in and call you if they want to really set up a detailed budget, but kind of a broad brush, what kind of a process do you take people through?
Well, it's exactly the questions you're asking. It's almost like an interview, and that's what makes this show unique and helps out the community within the library. It's like our job. It's like someone goes to the library and asks you to find where's the self-help section. Some people might, they want to do some things on their own, but they still need the guidance of a professional.
We're happy to trot up the steps.
Yeah, right. So, and depending on what level they are and how sophisticated their situation is, we can help them. Being part of a credit union, that's the great thing about it. It's member-driven. We are there to help the member. So we kind of run an interview just like we are doing now. What do you need? What are those expenses that you have? And what are some of the things that you want to do? And then we help frame some of those things based on our experience, because we've seen people live 20 years in retirement. I've been in business since the mid-'80s. So, I've seen people actually been retired for 20 years. So what are some of those things that they are facing?
So you start with the questions of what do I need? So in other words, what am I going to need money for, and how much is that?
And a great way to do that is, if we were sitting down, I'd say, what's your net income?
Okay.
Get out a pay stub. We don't get pay stubs anymore, do we? We were joking around earlier.
Actually, we get
cash.
We do get something that comes not with the check. The check, we never see the check.
Yeah, we don't see the check anymore.
Well, we get a piece of paper that said these are all the things we took out of it.
That's right. And here's the bottom line. But at my credit union, I have X amount go to my car payment, X amount go to my vacation fund, X amount go to my Christmas club. So what is that net number? How much am I really kind of living on? And that is absolutely the best place to start, because it will be a number and it will be real. And then if you say, hey, that it's $3,000 a month, whatever that may be. That's what you're getting after you put money in your retirement plan, after your taxes. This is actually what I'm living on. And then the next question I ask them is, do you have credit card debt? Because you could say you're netting $3,000 a month, but at the end of the year, if you're carrying a credit card balance, that would suggest that net income is not enough, right? So you want to add that back in. So, there's a little give and take during that discussion, and some, kind of come to Jesus moments to find out really what are we spending and what are we gonna really need in retirement. We rather have people have that discussion now versus they go to work, they have the retirement cake party, they get the watch, and now they're home in the living room. You don't want to have that discussion on need and want. You want to have that years before. So
that seems like a big border. If you're 5 years before, 1 year before, you've just done it. Now you come in and you say, John, I'm not sure I have enough money.
Yeah, and I've gotten calls. Yeah, I'm retired now. Okay, geez, that's.
I wish I could have talked to you a year ago.
I wish. And prepare, because there's just so many things can happen. It's safe to say there is this time frame, as much as 10 years, 5 to 10 years before retirement, and really 5 to 10 years after retirement. There's this area where you really just have to be smart, and you have to make the right decisions so that you're prepared for retirement. And it's different than when you're working, when we get up and we go, when we earn our paycheck and have the ability to earn that check each month, we can cover or make up for a lot of mistakes that we make. So,
I guess a budget is really important throughout our entire life. We need to have a roadmap of are we okay or not, and how okay. But it seems like at the point where you're retiring, you're entering a new, totally unknown area. I imagine, I know my parents had some unrealistic ideas about what they really wanted, and you put that back in my mind. You said, what do you want? But they didn't really know. They had this idea they were going to do something, they were going to be fishing all the time. That really didn't appeal to them once they got there. So if they had bought a 40-foot yacht to go fishing all the time, or a 70-foot RV, and then decided they don't really like camping, this would not be good.
Yeah, so sitting around the campfire, you don't want to all of a sudden decide, geez, every day? Right. And I enjoy golfing, maybe once or twice a week. Would I do that every day in retirement? Probably not. Would that take the enjoyment out of it? And I think that's what you're talking about.
Right.
Are things like hobbies or things that we like to enjoy doing while working, in between work, going to be enough to sustain us in retirement? And I would argue it's just not that way anymore, Richard, just because the diverse needs and wants of what people like to do is redefining what retirement is.
And you said 30 years. How would I know?
Yeah. And I think not only is the dynamics of retirement changing because of the length. Back when they created Social Security and normal retirement age 65, we talk about life expectancy, people only lived till 62, 63.
So Social Security was great.
Yeah, retirement planning was, make it there.
Right.
Don't die before. That was the plan.
Right, keep it together.
Yeah, keep it together. And we kind of joke about staying active in retirement and those wants, but I also think, personally, that it's important that the mind and body stay engaged. If you're so caught up in your 9 to 5 or 9 to 6, that work life, you're engaged. You can't lose that engagement, whatever that is, whether it's volunteering, work. Work is not a 4-letter word. When you live 30 years, don't be afraid to have a part-time job or what they call an encore career or a second job.
Nice,
don't be afraid to do that because it's important and it will keep you engaged. And as a financial advisor, I like it because it preserves assets longer because you don't have to spend them.
Right. Yeah.
Exactly.
And I just think it's so important psychologically too.
Oh yeah, that you're contributing in some fashion. I think it's important. And another thing about Capcom, what's nice is we have a foundation so we can stay engaged while working, outside of traditional work. So I would imagine when I retire, I'll keep engaged, whether that's I'm involved with Hudson Valley or our charity foundation, backpacks for children in the school systems and the younger, junior achievement, teaching kids about
And your skills and your knowledge set about retirement, you could certainly find a lot of people who'd be asking you questions anyway.
That's true. Well, it reminds me of a funny story. I was doing junior achievement. We were talking about need and want, just like adults do, but we were talking to second graders, and we were talking about need and want, and I thought I did a good job of explaining it, and I said, well, what about a TV? And the little boy said, well, yeah, no, TV's a want. And I said, oh, good, so they must be listening. Yeah, because TV's a want. You need a remote to actually work the TV. So I had a little more work to do in the classroom between
funny.
need and want. But, that reframing those discussions in retirement's important. And aligning the money you have set aside is just money until we can align it with the purpose. What is the purpose of that money? Is it to meet your housing expenses? Is it to travel? Is it to, fund your charitable endeavors? What is that? And that's our job. Align money with real purpose, because money in itself is really no help.
Okay, let's move on from budgeting.
Sure.
I don't want to get off of it if we left off something.
Yeah.
Obviously, you've got your categories, your needs and your wants, and you've got a list of all the things that you pay. Maybe you collect your bills, and so you see all the things that you've been paying, and you put down what you might want to do and what that costs. I read once, maybe somebody wants to give some money to the kids or leave something. How do you figure that in? Is that a need, a want?
Well, it varies for some people. Some people think the perfect legacy or estate plan is when the check bounces to the caretaker. Other people want to provide for their children or grandchildren. There's both ends.
Right.
There's both ends of the spectrum. Our firm is always first and foremost, we want to help people maintain their standard of living in retirement. So,
Now,
so
is
that's
it-
job one. Job two would be, okay, now we're maintaining our standard of living. What's next?
Okay.
You know, what is our legacy? What is our estate plan? You know, how can we help our children? And how can we help our grandchildren? And that's the next phase. That's part of the process, the
Okay.
planning process.
So we're about ready to
that
take
you're-
that step. We've got what it costs to do what we think we want to do and what we pretty much know we need to do. And now, how do we make that step over to the other side?
Yeah, well, first of all, you got to remember that we've decided what we want to do on paper, but there are real risks in retirement. Volatility and behavior risk are very big risks to our plan. So there's this gap of here's legacy, this is what we want to do, here's our standard of living, and then there's these risks we have to deal with, volatility. So obviously it's fresh in everyone's mind, the Great Recession. You know, we're in the second year anniversary of technically when the recession ended in June of 2009. So happy anniversary.
Right.
Well, what if you retired in a way?
Right at the wrong time, or at least that time?
Well, people did. We had people retire.
Right.
So there was a risk associated with that volatility. And the reason I bring that up, you know, as we progress to this legacy discussion, is that you have to be prepared for volatility. I like to say volatility, friend or foe. You know, volatility is our friend when we're accumulating money. So when we set aside money each month for our retirement, volatility is good, right? Because naturally when the markets or your investments are going down and you're putting in a fixed dollar amount, aren't you in essence buying them more shares at that lower price?
Right.
Automatically?
Right.
And then volatile, when the market's really high, aren't you buying fewer of them?
Right.
Well, that is our friend. In retirement, when you're drawing money down and producing a check, because that's what retirement is, it's really going from getting a check from somewhere else to getting a check from, you know, your investments.
I think this is where most people's questions are.
Yeah, and that's the volatility. You know, it makes a huge difference when you first, and it's really called sequence of return risk. And it's this, I've retired, I have $1 million or $500,000, and what if the market or your investments immediately go down and you're drawing a percentage from there? Well, if you draw 4% and you're down 8, you're really down 12. So what helped us was friendly during accumulation is our foe in retirement, because now you're selling more and more at the lower prices and fewer at the higher prices, and it just can create this downward spiral. The math works. I mean, you could see if someone retired and had 2 or 3 bad years in a row, it's almost impossible to make up for that difference throughout the life of your retirement.
Because you can't start putting more money in.
You can't put more money in, and you have to draw money down, and it takes much more. You know, if you have $100,000 and you lose 5%, well, now you're at $95,000. Well, it doesn't take 5% to get back to 100, does it?
We've seen how that
Takes
math works.
yeah,
because it wasn't
it doesn't.
5% some
Yeah.
of these times.
Yeah, and it does, and it takes more you got to make 9% to get back to that 100, because now you're at 95. So, you know, 5% of 95 does not equal 5. So,
And then-
you know, that's the challenge.
And for me to put my part in this stage setting, you think about the risk, and they tell us, well, higher risk, higher return.
Yes.
But higher risk, higher risk.
Yeah. The discussion in the last few years has gone away from what we would call traditional risks in retirement, which inflation. You know, when you're building a plan, a retirement plan, you take into account 4 major things. One is sustainability. You know, will your plan last throughout your lifetime? And that's kind of the questions you were asking.
And we should be thinking
If it
30
does.
years, unless
Yeah.
we're in really bad
There's
health.
sustainability, you know, and then how can I help out that next generation? The other second component is inflation. You know, healthcare costs, housing expenses, transportation. Those are your big 3 in retirement. You know, what are those costs going to be over time? And then you talk about the third thing, which is flexibility. We all know life happens. Well, what if something happens, an unplanned expense, a downturn in the market? You know, how do I handle that? You need flexibility in your plan. So, you want to talk about sustainability, inflation, and you certainly want to talk about having some flexibility. And then the fourth component is the legacy. What about your estate plan? So all those things you want to incorporate into your plan as you transition into retirement.
Now, in talking about it, what would you talk about next? Flexibility seems to me a really important one, but would that be the next thing you would work on?
Yeah, well, what you do is once you know how much they need, then you'd align. Remember, we were talking about money, and it's no good unless we can align it with purpose.
Right.
Well, then the third component is where should the money sit based on that purpose.
Okay.
So you bring some logic to it. So as an example, if we have sustainability or we have a fixed expense need that we have, maybe that money sits in something that provides higher guarantees or a little more security for that income. Because you were talking about, well, risk can be good because I can make more money, but I can also lose
my
more.
shirt,
Right, exactly. So when you align it with purpose and you say, well, here's my need, I'm going to get, maybe something that's interest only, where your principal doesn't fluctuate. And then maybe you align something, an investment based, that has a certain amount of more risk, but more potential, and maybe you align that for your wants, over time.
It strikes me that if you're talking about 30 years, and we used to not be talking about anywhere near that,
No.
now we're getting into pretty long periods of time where most, I guess, would I call them normal, or would I just call them regular stock prognosticators and advisors would say, well, if you only have 4 or 5 years, now maybe you want to be more conservative. But over 10 or 20 or 30 years, the market has pretty much gone up 7, 8%. Somebody might say more, but I'm not sure over the long run we can really count all that with inflation.
Yeah, you're correct. I mean, the last 10 years, the first time that there was a rolling 10 years where we didn't get a positive return just in the broad index, the S&P 500. But over time, equities do give a positive return, and you do need time. You shouldn't invest your money if you're going to need it within 5 years. So aligning it with purpose, lining something to cover fixed and want, the idea is that the money will sit there. And because it is going to sit there and it maybe draw down, take a certain percentage each month from it, and you're going to draw that down, then it can sit there and work through the market cycles.
I was just thinking, trying to soak this in and learn from you. If I had $1 billion and I came to you, how do I survive for the next 30 years? You would probably say, well, I don't think you really need me.
Yeah, well, of course I'd tell you you'd need us, because $1 billion has a whole nother set of problems.
And the whole community could use some of that.
There's a whole new set of problems, and we do have foundations and,
But as we work down to where somebody is, now you're saying, well, this is difficult. I'm not sure how we get you set up to match your wants and needs, or even your needs, with what I see as your assets.
Yeah.
Now,
revenue expense does not line up.
Right. Now do they have to have more risk? I guess that was where I was going.
Yeah, and you bring up an interesting question, because a lot of our conversations aren't, we don't tell people, they don't necessarily hear what they want to hear from us. But that's our job.
That's parents too.
Yeah, that's right. That's right. So the fact is, people have to make that decision, and taking on greater risk when it doesn't warrant it, just because you can't adjust the expense side of your equation, that's a problem. And we have hard conversations like that. And we've told people, you cannot retire.
Okay.
So
right.
You need to continue to work. The math does not work.
So one more before we get into some
Sure.
of the technical things that I think people have questions about, but you may know some other ones. Let's just move on. I'm not sure where I was going to do with that.
Well, what the concern is, and I could tell with the questions you have, is when do I say retire, and then will they match, and if there is a mismatch, how do I handle that?
Right. I was somewhere in there, but I couldn't phrase it.
But the risk you take on is not going to be. That's why we really just try to hone in on the purpose, because you have to make sure it makes sense to where your money is, to meet that purpose, but it also has to meet the test of how much risk are you willing to take.
I know what I was going with the other part. If you're not willing to gamble, and we don't like that word, especially
Sure.
when you put it next to the stock market,
Yes.
then you have to be flexible in how you expense. So am I willing to say, well, I wish I had a 3,000 square foot home with 3 bedrooms so all the family could stay here,
Certainly.
but maybe I really can only afford a studio. I mean, really.
I agree. There's the summer blockbuster movies are out now, and it's Transformers. My son's 8, so we go to Transformers, and lead character is Sam Witwicky. And the saying for the Witwicky is, no sacrifice, no victory. And the fact is, planning for retirement takes sacrifice. You may have to not have as big a house as you anticipated. You may have to go on vacation every other year. I mean, there were years where I just didn't go on vacation because I wasn't comfortable with, the balance sheet, the expense ratio. Those are things that need to be sacrificed to eventually be prepared for that financial independence, and that's what we're talking about.
Right.
The ability to live without working for a paycheck, that financial independence. It takes sacrifice, and that's a lot of the stuff we talk about, Richard, is that, and those are the hard conversations.
So I'm going to try some very specific questions,
Sure.
and if you think of something more general that I should have really asked you, go ahead and throw those in.
Sure.
One thing I think we've learned, though, is I think anyway, is that I used to think in terms of how much of the money that I've saved can I draw down. And now I'm pretty much to the point where I say very little, because I don't know how long I'm going to live, and the downside of running out is much bigger than living within my means.
Yeah, and that would be great if everyone thought like that, because that's really how it has to work. And there are repercussions, and part of our job, Richard, is to take what you're talking about. So depending on the income you want, we've talked before about, geez, what if I just withdrew 4% of my pot of money?
Thinking you're going to make it back.
Think I'm going to make it back, or my investment strategy will be able to sustain that bucket. Well, it's easy to say I'll only draw 2. But if you have $1 million and you draw 4, that's $40,000. You go down to 2, that's 20 grand. That's $20,000. So that's a 50% cut in revenue. Can you deal with that? And if not, that could impact your legacy plan, right?
Right.
So you may assume, well, I'm going to pull that, and maybe that $1 million won't be $1 million. Maybe it will be, $500,000.
So would it be right to say then, if you've got a $20,000 differential here, that you should have an expense budget which could adjust that much? I can go on several trips. I could save 1% maybe for the next time I only get 2%, or I have some options.
Or you could say, I'm okay with my pot going down. Those would be the two choices.
Okay.
Think of it in terms of people that get a pension check from a company. When that is calculated, it takes into account those life expectancies that you talk about. And instead of having $1 million, the company you work for has that pot of money. But they take on the risk of making sure that income pays for you and potentially your spouse's lifetime, right?
Right.
They don't calculate that money is sustained. They calculate that it's used to pay that.
Okay.
So.
But they have a larger number of employees, I guess, but we've still heard problems with companies' pensions.
Yeah, but the concept is still the same. We're just doing it as individuals, and we've set that up for clients. We've set up, because we could go to insurance companies right now and give them an amount of money, and they'll give you a pension check.
Okay.
So we've done that for clients. We've actually set up income streams for certain periods of time and set aside investments to rebuild while they're pulling a guaranteed income. So as an example, someone retires and we want to make sure the next 10 years they get a certain amount. Well, we could go to an insurance company, give them a certain amount, and they'll guarantee that income no matter what happens for 10 years. And then we take a piece of their other investments and set it aside in an investment that'll, over the next 10 years, will kind of grow to then replace and be in a position to replace that income when that 10-year stops.
So then could I correctly say that if somebody comes to you and they're flexible enough to adjust their expenses within a certain level, you would be able to make them feel much more comfortable by what kind of instruments and how.
Yes. Yeah, so that's what you do. You line up, what is the purpose of that money with the particular investment strategies or products even that are out there that can help you meet that need, whether that's what they call annuitizing, which is what I just talked about, where you give the money to someone just like a pension plan, and they get the money, you get the check.
Okay.
Or just a pure investment.
Would you recommend that someone actually save a little bit in the beginning? You mentioned inflation, and I'm fairly concerned about that. We've had such low inflation. It seems like things, if we had a surprise, it's going to be a bad surprise. How do you deal with higher inflation?
Yeah, well, you have to have some money set aside to prepare for that. So it might be kind of quarantined and taken out of the income production stage and set aside just for that.
Okay.
If expenses get too great.
Right. Are they still recommending a mix? Because it seems also with that long period that stocks would almost have to still be a part of a plan.
It's a larger portion than they used to recommend based on longevity risk, of living too long. So, I could just tell you generally, in general purposes, everyone really has just got to talk to another, a professional to get that advice. But we very rarely, for retirement portfolios, go over 60% exposure to equity markets,
But that's pretty high, even
20 to 60.
from what people used to say.
Yeah, and that would be backup money. That wouldn't be money that we would necessarily use to produce a check.
Okay.
So, because you have to balance that amount of risk willing to take to money lasting. That sustainability we talked about in retirement.
Right, and I think this trend goes back at least to the 70s, where Fidelity, and of course the market was doing well a few times since then, a number of shocks, but when things were going well, they would say, you can't really afford not to be in stocks because of inflation.
Yeah, it was a little misleading because of high interest rates. I talked to a lot of people, geez, I used to make 10% on my savings account. Well, sure, but the cost of living was increasing at a far greater pace than that. So you were actually, if you included that with the higher tax rates we had back in the late 70s, early 80s, people were actually at 10% interest were losing after inflation and taxes, which is hard to believe.
Yeah.
That's how fast, the cost of living was going.
Timing on some of these things. Now we have to take money at some point, 72 or something like that?
70 and a half. That's correct, required minimum distribution.
But most people are retiring, what, 66, 65?
We've had some before 60. We have some people at about 65, 66.
So do some people think, well, I'm 66, I need to now call my broker and say, okay, set up my distribution? Maybe that's not a good idea?
Well, your money, again, is only as good as fulfilling your need and want or what that purpose is. So if you need a check at age 66, then you start pulling at it.
Okay.
So the fact that the government can't wait for their tax money and require you to start pulling something at 70 and a half does not dictate to you that you pull a check.
So there's this balance of all the possible revenues that you can have.
Yes.
And you really need to have a conversation with someone, unless you're already working in the industry.
Yes, right.
To try to figure out where I should start, what money I should take first, that kind of
Yeah,
thing.
timing. So if you think of a timeline, you think here's my 25, 30 years, and here are my sources, Social Security, if you have a pension check, if you have a 401k, working, if I'm working part-time, kind of load them up and say, well, what are we going to do from 65 to 70? Well, I've got a part-time job, I'm going to work here, my Social Security is X, I have a small pension, that's enough for me. So then you're not going to draw on your retirement accounts for 5 years, and then we would say, well, at 70 and a half, the government's going to require you to start, and that first year it's around 3 to 3.3% that you have to pull out.
Okay.
And then we incorporate that into the cash flow scenario.
Now, one kind of similar question on Social Security. Depending on your age, of course, you need to start taking Social Security, right? Or you don't have
Government
to
doesn't
take
mind if you waited.
Okay.
They don't mind.
And does the amount that you get back go up if you
Yes.
put it off for a
Yes.
year, each year?
Less penalty, and you get you can start pulling. You could wait till age 70 to start pulling. And it's an interesting question because the dynamics of Social Security and when to draw are changing. So just a few years ago, at 62 is about the earliest you can draw Social Security retirement. And as a rule of thumb, you started to draw it now because even if you could get more at what they call your normal retirement age, which for some people is 60, mine is 66, others 65, 60, wherever that lands, up to 67. You would start pulling now because even if you waited, it would take 13 years, 12 years, 14 years of earning that extra amount to make up for those 2 to 3 years that you were pulling from Social Security. Does that make sense?
Yeah, absolutely.
But because cost of living and people living longer, now Social Security has not had a cost of living raise in the past 2 years, but traditionally they do. And it's one of the few sources that actually still does that. I don't know of any pension plans that do that.
Right.
So some people, it might make sense to draw their assets and wait on drawing Social Security.
So it's really on how long you think you're going to live.
Yeah, and of course.
If we have a target,
don't know that.
We'd like to live to be 90, let's say, or we'd like to cover it to be
Yes.
90. That might, depending on, I'm not saying we can tell anybody what to do in their case without looking
Sure.
at the details, but it very well might be better to put it off if you're going to really
might
think,
be.
I might be 25 years living on this money.
Yeah, or if you happen to be working, and still enjoy it, why draw on Social Security when you can have that, get a little bit more, and there are some limitations where Social Security is taxable at certain rates, and if
Okay.
you earn before normal retirement age, they can take some of your Social Security back.
So you really need to sit down with each of these scenarios and look at
See what role that
how
plays.
it adds up with a calculator.
My finance degree comes into play every once in a while, which makes my dad happy. So
That's good.
you got to use it
He
every
pushed
once in a
you
while.
into that.
Yeah. Well, no, he was an engineer, but he's happy to see that our joint investment in college is paying off because I'm using my degree. So let's put it that way.
That's good. Well, I think, there are a lot of other questions that I can think of. Would you like to wind up with something and kind of give people advice in terms of looking at retirement?
Well, Richard, as always, you've set the stage very well, and you had the appropriate questions to help people. And this is really, hopefully, people are just taking a second look at their statements and thinking more about retirement. And two things. One is it is a journey, not a destination. So make sure there are certain mile markers that you want to hit before retirement, at retirement, and after. Make sure you're paying attention during that time frame. That's just general advice. Very specific advice I'll give is that people need to remember in retirement, every day is Saturday, because you're waking up and it's a Saturday. You don't have to go to work. And with that comes the need for greater amounts of cash.
Which is just the opposite of what we were all told. You don't need as much money in retirement.
You need more cash because every day's Saturday in retirement. And cash gives you much more flexibility, in retirement based on all these things that we talked about, volatility on investments, meeting your expenses if you have the cash to do it. So every day Saturday, don't be afraid to have more cash than you think is necessary going into retirement.
Sounds good.
It sounds good. Yeah.
Well, I hope people give you a call. We'll put the
We'll
number
be here.
up.
So
Thank you.
thank you, Richard.
Great show.
Appreciate it. Yeah.
Thanks.
Thanks.
And I want to thank you for watching. I hope you enjoyed the show, that you tune in again next time, and that you have a great week. Take care.
Welcome to Channel 17, the Town of Colonie Government Channel.